Wouldn't it be great if you could instantly access cash without waiting on a bank loan? For real estate investors, this dream is closer to reality than you think. With a bit of creativity and a solid understanding of credit card strategies, you can legally transform available credit into usable capital for deals, repairs, or unexpected expenses. Below, we'll explore practical legal ways to turn your credit card into a short-term financing tool for real estate ventures. Why use credit cards for real estate? Real estate deals often demand immediate cash, whether it's a down payment, renovation costs, or emergency fixes. For beginners or those unable to secure a business loan, credit cards can act as temporary interest-free loans when used wisely. Cards offering 0% APR on purchases or balance transfers provide a time-limited opportunity to access funds without traditional loan applications. As OPM Capital suggests, using 0% APR cards can be a straightforward and fast method to finance short-term gaps, so long as the debt is paid within the promotional period. It's not just about convenience. If you manage it responsibly, it's a smart leverage move using other people's money. Method 1. Cash advances. Cash advances are one of the most direct methods to get cash from a credit card. You can withdraw money from an ATM or bank, but it's expensive. Most cards only allow 20 to 30% of your credit limit for cash advances and charge steep fees, often 3 to 5%, plus immediate interest at 20 to 30% APR. Example: on a $1,000 advance, you might pay a $50 fee and then interest at 25% until repaid. Unless you're moving that balance to a 0% interest card quickly, the cost can be brutal. Cash advances work fast, but should be a last resort due to the high fees and interest rates. Method 2. 0% balance transfers. This is a smarter alternative. Many credit cards offer 0% APR on balance transfers for 12 to 18 months. The trick is to first take a cash advance from one card, then immediately transfer the debt to a 0% card. Example: you take $5,000 from card A, then transfer the balance to card B with a 0% APR for 15 months. The transfer fee, typically 3%, is much cheaper than paying months of interest. Warning: if you miss the promo deadline, interest kicks in. Also, applying for multiple cards too often can lower your credit score. Use balance transfers to minimize cost, but plan your repayment schedule. Method 3. The return hack. Not recommended. Some attempt to turn purchases into cash by returning items for refunds. While some stores refund to a card, others offer store credit or cash. Abusing this method, like claiming defects or demanding refunds to alternate methods, is considered fraud. Highly risky and legally questionable. Avoid this one entirely. Method 4. Gift cards to money orders. This method, often called manufactured spending, involves purchasing Visa or MasterCard gift cards with your credit card, then using them to buy money orders, e.g. from Walmart, which can be deposited into your bank. Example: buy 5 $1,000 gift cards, use them to purchase 5 money orders, and deposit the total to your bank. After small activation and money order fees, you've converted credit into cash. Risks: banks may flag large or frequent money order deposits. Some cards prohibit gift card purchases, and issuers may shut down your account if misuse is suspected. Pro tip: keep transactions modest and spaced out. Use banks that accept mobile deposits for money orders. By the way, if you're debating renting versus buying a home, check out our last video, Renting versus Buying, which one's right for you. We break down the pros and cons. It might help you decide before you invest in property. The link's popping up and in the description. Now back to cash hacks. Method 5. Bill pay platforms. Plastiq and Melio. Services like Plastiq and Melio allow you to pay bills, like rent or contractor fees, with a credit card, even if the payee doesn't accept cards. They'll charge your card and send a check or ACH payment on your behalf. Example: pay a $2,000 invoice with your card, Plastiq charges you $2,058, including a 2.9% fee, mails the check, and you earn rewards. Use case: great for meeting sign-up bonuses, earning rewards, or covering bills when short on liquid cash. Downside: that 2.9% fee adds up. On large amounts, the cost can outweigh the benefits unless you're also gaining substantial points or cashback. Method 6. Convenience checks. These are pre-written checks that draw from your credit card balance. You write one to yourself or a payee, deposit it like a normal check, and the charge hits your card as a cash advance. Example: write a $1,000 check, deposit it, and now you owe $1,000 plus a 3 to 5% fee and interest, often 20 to 30% APR. Pro tip: use these only if you can immediately pay off the balance or transfer it to a 0% card. Like ATM advances, these carry high costs. Method 7. Overpayment and refund requests. If you overpay your credit card, the issuer technically owes you that credit balance. If requested, they must issue a refund check. Example: you pay $5,000 to a card with a zero balance. You then ask for a refund of the credit balance. A check is mailed to you within 7 to 10 business days. Warning: many issuers will return overpayments automatically or flag them. Overuse can result in account closure or scrutiny for suspicious activity. Use only in moderation and never as your go-to strategy. Method 8. Credit card liquidation services. There are companies that legally convert your card balance into cash. They process charges as if you're buying a service or product, then send you the equivalent cash minus a fee, usually 3 to 5%. Example: liquidate $10,000 through a provider for a 4% fee. You receive $9,600 in your account. Risks: trust is key. Some of these services are unregulated or operate in gray legal areas. Scams and fraud accusations are possible. Additionally, card issuers often prohibit using your card for this purpose. Best practice: research any service thoroughly. Ensure they're reputable, transparent, and offer documentation of all transactions. Final thoughts: use credit responsibly. Turning your credit card into cash can unlock funding opportunities for your real estate ambitions, but each method carries different levels of cost, risk, and complexity. Some strategies, like 0% balance transfers or bill pay platforms, are relatively safe when used correctly. Others, like cash advances and refund tricks, should be approached cautiously or avoided altogether. Always read your card's terms, consider your repayment plan, and consult a financial advisor if unsure. Real estate can be a game changer, but only if you protect your credit and cash flow. Remember, just because you can do it doesn't mean you should. Every strategy depends on your risk tolerance, timing, and financial discipline. If you learned something or have other tricks, drop a comment below. Which method would you try first? Do you know any other credit hacks we missed? We want to hear your thoughts. And hey, if you enjoyed this deep dive, hit that like button and subscribe for more finance and real estate tips every week. Until next time, keep your credit smart and your investment smarter.